I think I mentioned that there's a possibility that long-term interest rates may have peaked, but I think today I have to reverse that because quite obviously we are going to be in for a big surprise because long-term interest rates have climbed. US Treasury 10-year yield rises above 4% to the highest since 2008. Today's video I'll be sharing with you what I will be doing, that's the first part, and second part I'll be sharing with you a little bit about Trust Bank. Because just in case you have maxed out Singapore savings bonds already, I think from my preliminary research, it's still possibly the best bank account out there that you can get some interest. And last but not least, I'll round up this whole discussion with my best guess as to where the November rates are going to be at for the Singapore savings bonds. So if you're keen to find out better, continue watching on. Hi guys, welcome in. I've always believed that Singapore savings bonds are best for parking emergency cash. They are not a place for you to build wealth. The place to build wealth is in the equity markets, especially right now when we have a bear market. But in terms of emergency cash, what you need to prioritize is liquidity. Singapore savings bonds allow you to take out that monies with just a month's notice. And if you think about it, if you have any emergency, you simply need to just swipe the credit card and then liquidate your Singapore savings bonds to tide through that crisis. But I think that scenario is pretty extreme, and I personally haven't even seen that happen to myself before yet. I've also allocated some amounts to Singapore savings bonds. As you can see in this screenshot over here, I've slowly accumulated 18,500 in July's issue, 9,000 in August issue, and 10,000 in September issue. This is about 3-4 months of total family expenses. I actually missed out on the October issue, so that part I didn't participate. But upcoming, if the interest rates are even higher, I might pump in a little bit more just to beef up to 6 months worth of emergency cash. Now, Singapore savings bonds, the main complaint usually is the maximum is 200,000 per person. I don't know if you know that rule or not. And for some retirees, they do have more than 200,000 worth that they want to park into very safe assets. So that's why T-bills now are so popular. And not just them, bank deposits also. That's why in this section, I'll like to touch a bit on this Trust Bank, which is actually a collaboration between NTUC and Standard Chartered Bank. I started to play a bit more with Trust Bank, and let me show you what I already know, just in case you haven't gotten the account for yourself. The adoption rate has been pretty strong, and simply because the sign-up offer is pretty good. Right now, they are giving 1% as base interest, and you do get a bonus 0.2%, at least for myself as a non-NTUC union member, which means the total is 1.2% per annum if you simply caught 5 minimum transactions. I actually top up $100 into my own trust account, and I've actually started to use it quite a bit already. So you can see I've been making transactions. So 2 more card spends to unlock that 0.2%, but right now it's only $87. I don't intend to pump too much in also, that's not my point. But if you have maxed out your Singapore savings bonds and you're really looking for higher interest in bank accounts, this allows you to get high interest for the first $50,000. Now also, if you are a young working adult that you do not have too much in terms of free cash, that you want a savings account, then I think this definitely beats OCBC 360, UOB One account, and DBS multiplier quite easily. And not just that, when you do a sign up right now, there's actually a $10 if you use my referral code below. And there's a $25 NTUC Fair Price e-voucher once you make a single transaction. This is me at VivoCity. So for today, I've actually redeemed my own, buying some Yakult and milk. And they actually have a Trust Account Bank ATM right there. Now, just now I mentioned about high interest accounts, correct? I went to check a bit on OCBC 360 because that's where my salary is going. But it's a bit disappointing personally to me. Because if you see this breakdown, you realize that first 50,000 with salary is 0.6%, and I do spend on the OCBC card. That's only 0.6 plus 0.2, total of 0.8 for the first 50,000. And that's already with certain hurdles that I need to jump across. But in any case, for big amounts, I do intend to deploy into the equity markets. So I'm not really aiming for the bigger tiers. I checked around for DBS multiplier. There are also hurdles to jump across. Most important is salary crediting. If you are a retiree, that is difficult to qualify. UOB One account doesn't need salary crediting, but you do need some gyro transactions. And even with this recent revision, it still doesn't look that appealing yet. So if you are keen for an update on the best bank accounts, do leave in the comment sections. Especially if they do a further revision upwards that looks more attractive, I think that's when I'll do a tutorial on it. And speaking of banks, let me give you an update on it, just in case you are a shareholder. You've seen, right, news mentioning that there are 4-hour queues queuing up for fixed deposits. Right now, banks are giving 2.7%. Now, the simple reason as to why there's so much FOMO is because we are also conditioned with 1%, 1.5% for fixed deposits, and suddenly 2.7% looks an exceedingly good deal. But later I explain to you that this is likely going to be smashed. Not just that, banks are seeing a surge in savings account openings as interest rates are rising. And what they're doing right now is UOB and DBS have both removed their fixed home loan rates, and they are going through an ongoing review. Now, in the previous video, I did mention that DBS's 2.75% fixed for 3 years, 2 years seem about the most attractive in the market. And if I'm not wrong, that has not been too profitable because interest rates have risen, correct? So that eats into their books. But all in all, what I can see from the surface at least is banks' margins are likely going to be fat moving forward. The CASA ratio, the current account savings account ratio, is looking healthy, which means banks bring in very cheap deposits. You see all this, they give 1% thereabouts. They can loan out at way higher amounts. So that increases the net interest margin. If you're a bank shareholder, profits are likely going to be fat. But let's go back to the Singapore savings bonds. I mentioned that the new interest rates are likely going to shock you. Let me show you some history first. This is what I flashed out in the previous tutorial. You see the August rates were 2% on the 1 year, an average of 3% on the 10th year. Then September, 2.63%, an average of 2.8% on the 10 year. The 1 year interest increased, but the 10 year amount dropped. Then for the October issue, you realize that both the 1 year and the 10 years have dropped. 1 year is now 2.6 and 10 year average is 2.75. That gave me the impression that there was a possibility that interest rates may have peaked. But what do we see happening in US treasuries? The short tail, which is the 2-year treasury rates, have spiked, especially in the last month. That's because Fed has raised interest rates by 75 basis points, correct? The 2-year rate right now is at 4.166%, which is a 70 basis point jump in the last 1 month. The 10-year treasury is also jumped significantly. Previously at 3% flat, now it's about 3.899%, and that's a 90 basis points jump. There is still a yield inversion, which suggests a very strong likelihood of recession if it isn't already here. And that leads to my best guess as to where the next Singapore interest rates will be priced at. And before I give it to you, help me smash your like button because it's taking hours to prepare this and I'm filming this late at night. And if you like content like this that helps you in your financial journey, smash on the subscribe button. My best guess for the 1 year rate will be about 70 basis points higher than the previous one, which means quite possibly 3.3% on the first year. That is actually around what is being offered by the T-bills right now. The 10-year rate is the one that we should be focusing on, especially if you're looking for emergency cash parking. And for the 10-year rates, I do believe a 90 basis point jump is quite possible. 90 basis points means 0.9%. So if you look what has happened for the previous one, I think this new issue for November 2022 for 10-year average could be 3.65%. Wow. Suddenly your CPF OA rates at 2.5%, the CPF SA at 4%, they look quite sucky already because they have no liquidity. Singapore savings bonds 10-year rate could be 3.65% already. If there's ever a chance I'm correct, I also don't know how am I going to sell endowment plans already because 3.65% for 10 years. Right now, insurers haven't quite revised what they're offering. So this is quite possibly the best place if you're looking to park for your kids' education and stuff until market reacts with a different product. I've also a further guess to make. The allocations for this one that's just closed for October 2022 could be bigger than expected because right now it seems that everybody's gravitating towards fixed deposits and T-bills. When I'm selling 3-year endowment plans, the take-up rate was not as strong as previously. So my best guess for this October issue is allocations could easily exceed 20,000. So we'll find out in the next few days and do stay tuned to it. And thank you for watching till here. I've actually previous tutorials that I'd like to suggest for you also. This first one touches on Singapore savings bonds ladder. If you are a retiree looking to build passive income, follow that tutorial. I think it can help you a bit further. The second one over here is why I'm actually not in favor of buying treasury bills and fixed deposits. Because 2.7% on fixed deposits suddenly look quite low, correct? Once you understand the power of the Singapore savings bonds. Follow either of these tutorials and I'll see you there too. Take care as always. Goodbye.